What's going on, guys? Welcome back to the channel. My name is Mark and this is 360 Finance. In today's video, we're going to be discussing Canopy Growth just because they released their Q1 earnings. Ultimately, I'm going to dive deeper into their financials as well as their management team and talk a little bit about whether I think you should buy Canopy Growth. This is a company that's been through a wild ride in the past few years as the cannabis market has jolted to superiority in Canada as well as internationally. So we're going to talk a little bit more about what they're reporting in their Q1 earnings results, what I'm looking for, and ultimately whether I think you should buy this company. Full disclosure, I own 0 shares in this company, so this is a completely unbiased opinion. If you guys do enjoy this content, please don't forget to like the video as well as subscribe to the channel for future finance content. Alright guys, so before we jump into their Q1 earnings results, I just want to read a statement from management. Proud of our strong first quarter performance despite unprecedented volatility and uncertainty in the market and across the globe. We grew our revenue year over year and are seeing market share improvement, notably achieving #1 market share in cannabis-infused beverages in the Canadian market. We are implementing a renewed corporate strategy with the appointment of a new leadership team which will focus on delivering quality products to our consumers, positioning our business for continued growth, and the proposed retooled acreage announcement refocuses our entry for the evolving US market where we are seeing increased momentum. Following our previously announced restructuring actions, we have substantially reduced our expense and cash burn in this quarter. In addition to reducing headcount by over 18% since the beginning of the calendar year, our marketing and R&D investments are being reallocated to programs with high return potential in order to drive sales. Our gross margins in the quarter came in below our expectations due to underutilization of our large-scale infrastructure. We've already proven we can deliver 40% plus gross margin and are confident that we can return to that level as we work toward higher capacity utilization across our facilities as our demand for our cannabis products continues to grow. In the meantime, we are focused on further optimizing our operating footprint through a full end-to-end strategy that looks at people, process, technology, and infrastructure that we believe will lead to best-in-class margins over time. Just to kind of break that down, I think the main takeaway here is that they've basically reduced their headcount by almost 20%, and that's basically why this new CEO was put in place by Constellation Brands, because the last CEO, Bruce Linton, was kind of seen as more of a business visionary and kind of had a reckless spending behavior. So looking at their Q1 2021 key financial highlights here, you can see that their net revenue grew 22% year over year. Their adjusted gross margins increased by 13 percentage points. Their adjusted EBITDA is about the same, and they had a 51% increase or improvement in their free cash flow, which I think is huge, but their cash and marketable securities did decline by 35%. So net revenue was driven by higher medical sales and the strong stores and Bickle vaporizer sales, which had higher distribution in the United States, and as you know, that was an acquisition that they made this year. Their adjusted gross margin was negatively impacted by lower production output as well as manufacturing variances and inventory adjustments. Adjusted EBITDA loss narrowed slightly, driven by lowered sales and general administration expenses, offset by a reduction in gross margin, and like I said, they had about a 50% improvement in their free cash flow. Moving on to the key takeaways, so advancing against our key strategic priorities. I think these 3 points are just, management kind of being raw. There's nothing really to take away from these 3 points. Their consumer-centric approach, strengthening their performance in Canada and focusing on growth in the US, as well as improving execution and agility. Not much to take away there. We just kind of want to see the numbers. So Q1 results showed resilience performance against a volatile backdrop. So obviously they're reporting these numbers in the midst of a global pandemic. So great to see that net revenue grew by 22%. Balancing their cost discipline while investing for growth. So like I already said, they reduced their headcount by more than 18% since December. Their sales and general administration expense ratio declined as compared to the last quarter, and their free cash flow improved by more than 50%. All very significant improvements in terms of cost. This next slide I found kind of interesting, called tracking our KPIs. So they had 5 KPIs, basically at the bottom here: customer order fill rate, gross margin near 40%, sales and general administration ratio trend downwards, working capital trend target, and a CapEx trend target. There's 3 categories that I wanted to highlight, but basically the first one was the customer order fill rate under quality execution, and this is measured by targeting 95% of supply attainment. As you can see, it's changed from below target to approaching target, and that's significant because it's showing improvement, and that you could see on the left hand side of this slide that they actually attained 87% supply attainment. So well on their way to 95% there. The second one is the gross margin, which achieved 40% in Q4 2020. Unfortunately, that came below that target for this quarter, negatively impacted by lower production output as well as manufacturing variance and inventory adjustments. The last thing I wanted to point out is the improvement in the sales and general administration ratio trend, and it had a material change and is actually declining as a percentage of sales, which is something that management has stated they want to improve, so changing from red to green there. Moving on to the revenue performance by segment. So this gives you a deeper look at which businesses have grown or declined specifically by segment. So you can see the Canadian recreational net revenue is down double digits in both business to business as well as business to consumer. However, this was offset by both the domestic and international medical markets. So the international market specifically was up 92% year over year. All other net revenue was also up 71%, driven mainly by the acquisition of the Stores and Bickle vaporizers, which had increased distribution in the US. I think the key takeaway here is that if this company is going to continue growing, it's likely going to be internationally as well as in the medical market and not the recreational market. So now looking at the revenue performance by format, you can see here that the dry bud sales were down 34% year over year in the recreational Canadian market, which might indicate that the initial buzz of being able to legally purchase marijuana is actually slowing down. Oil and soft gels led the charge for the global medical segment, and that accounted for 70% of total revenue. So I think as most expected, the recreational market is just the tip of the iceberg. International markets, specifically the medical international markets, has plenty of room for growth, and I think, like I said previously, that's likely where the company is expected to see growth in the future. Okay, looking at some more financials here, the operating expenditures trend as well as the operating expenditures as a percentage of net sales. Most of you probably know the former CEO of the company, Bruce Linton, was terminated by the company in July 2019, as most believe that he was a reckless spender, as he was basically handing out share-based compensation to all employees of the company, and usually that's not something that's given out until you reach, like the C-level executives of any company. So unfortunately, his business visionary mentality created a cannabis market worldwide, but unfortunately it's that mentality that drove him to potentially overspend with the hopes of creating this market. So specifically, his use of share-based compensation was seen as absurd, as he was paying administration level employees with sales share-based compensation on top of a regular salary. So as Constellation Brands wanted to protect their investment into this company, they appointed their CFO, David Klein, as CEO of Canopy Growth in order to cut costs and focus on profitability. I think the main takeaway from both these graphs are decreased costs, mainly in share-based compensation, and some of those costs have been reallocated to research and development, although a slim amount. The main takeaway, again, is the past 3 to 4 quarters you have decreasing operating expenditures. Moving on to adjusted EBITDA and free cash flow, and I think this was the most important aspect of this earnings call. As you can see, for 4 consecutive quarters now, adjusted EBITDA and free cash flow have both been improving. Although they aren't positive yet, they are improving, and I have a quote from an analyst from MKM Partners here that I wanted to share. Bill Kirk pointed to the company efforts to cut back on expenses, which helped offset what he called a lighter than expected adjusted gross margin at 7%. That said, they still have difficulty envisioning Canopy growing into their expense structure. He pointed out to an industry-wide supply glut as well as consumers' trends toward cheaper, lower margin pot. He notes that legislative changes and industry-wide excitement could provide upside to shares. And that's kind of my take as well. There has been a lot of overspending in this industry, specifically by Canopy Growth. And as there's all these mom and pop shop marijuana companies that continue to pop up, there is a massive, massive supply glut. And as most of you know, Economics 101, when you have a supply glut with constant demand or even slightly increasing demand, a supply glut is not good for prices and ultimately shares. So after looking at the company financials, I think that it's pretty clear what the path to profitability is for this company. It's international as well as the medical market. If this is an industry that you believe in long term, I do believe you should be buying shares in this company. If this is something that you're completely against and you don't believe that the US as well as any other international markets will ever adopt full recreational cannabis legalization, then you should avoid this company completely. My personal opinion is that sentiment towards this drug is changing, and that is set to change in the US in the near future with the election coming up in November 2020. I do believe in this industry moving forward, and if I were you, I would be buying shares in this company. From a valuation standpoint, Canopy is the leader in the Canadian cannabis market, and it will continue to be that way moving forward. So that's all I have for you guys today. If you did enjoy, please don't forget to like the video, subscribe to the channel if you got any value out of this video, and share the video with a friend if you learned something. As usual, guys, have an awesome day. See you guys in the next video. Peace out.
Young age, learn how to get paid. Big stage, long way from session A. Big wave, he gon' have to get saved.